For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Welcome back. Another episode. Wow, has it been a week already? It has been another week. Thank you for joining us. All of our regular listeners, always glad to have people here listening and telling us what they want to hear, what they want to talk about, what we should talk about. If you have any suggestions on topics, please let us know. Go to luciacap.com and send us an email, and we'll be happy to at least consider it. Now, we can't get to everybody's topic, but I'm Johnny Dean, your podcast host. This fellow with me, Professor Rick Plum, CFP professional.
Good day.
Good day. Good day, mate. Nice to have you with me, too, as well. A lot of things to talk about today and through the rest of this season here, as I don't want to cover too many topics on one because one topic can lead to another. But the thing that we have not talked about, and I look back on this, and I'm kind of surprised because this is a big topic in our Bucket Strategy Investing show. Remember that we did for a long time? Remember that?
Many years ago.
That's right. Boomer's Brain Trust, even before that.
And that's because target dates were just coming out.
Yeah.
And now they're more mainstreaming.
Yeah, target date funds. And so there seems to be not a lot of information out there about them, and yet they are common. I just happened to look, and we'll talk about what these are in a second, but the Plan Sponsor Council of America, and I saw this on CNBC.
And plan sponsor means retirement plan sponsors.
Right. I saw this on CNBC, said 80% of 401k plans offer a target date fund. And
right.
That's why I think we need to talk about this because they seem great, and I think maybe they can be good. I'll get your opinion on this. Let's start off, first of all, and just describe for those who don't know what a target date fund is. They saw it in the title and they said, what are we talking about?
Well, I'm going to take one step back from that and say, why do we even have these? And one of the reasons that target date funds were created and implemented and pushed, basically, was to get more people involved in saving for their own retirement, get more people into a 401k. There were a lot of people who did not use their 401ks because trying to choose the particular investments was daunting to people. They get this list of anywhere from 15 to 500, different investments in their 401k. Which one do you use? And you got paralysis by analysis, and people did not use their 401ks or were not using their 401ks because they had no idea how to evaluate which funds to use, which ones to use. What's the difference between a small cap and mid cap? What's the difference between a stock fund and a balance? They just got crazy. There was just too much there for them to do, so they just did nothing. And so the idea was to make available a fund based on a person's target retirement or target date for leaving that was allocated appropriately. So you, as the investor, don't have to understand which mutual funds inside your 401k you're using. You pick a date that makes sense to you.
Okay, so I'm 30 years old, and I say, well, okay, so 35 years from now, I'll retire at age 65. So I have 35 years until I retire, and we'll say it's 2023.
35. Come on, John, do the math.
Plus 35 is 2058 or something.
Right. So you're looking at a 2055
is that right?
or 2060 fund.
No, wait. Yeah.
Yeah, you're right.
30. Okay, thank you. I was going to have to edit that out if I was wrong. All right. So I say, well, if my target year to retire is 2058, I would look at a target date fund.
And the concept behind the target date is that if you have a long time, you can be a stock investor. If you have a short time period, you can't be or shouldn't be a pure stock investor. So the idea is that so as you get closer to your date, for whatever reason you picked, whatever date it is, the allocation of stocks and bonds or more aggressive, less aggressive investments in that fund, in your own one fund, changes. If I've got 40 years, I can be 100% stocks. If I've got 4 years, I can't be 100% stocks. And it kind of goes with the old adage of start with 100 minus your age, and that's how much you should have in bonds or stocks or whichever way they're selling the idea that at that moment. And so the fund itself lives with you and changes as you get older. You don't have to do anything.
That's the idea.
This is a one-stop shop just set it and forget it. And you don't have to think about what you're invested in. We're doing it all for you. Can you tell I don't like them much? I mean, I guess the sarcasm hasn't come through enough. But
I should have said spoiler alert, because you're giving away the
but the
plot
concept
here.
there is that they are doing all the legwork for you.
Is it a fund of funds? Is that the deal?
In many cases, it's a fund of funds.
Okay.
In some cases, it's a fund of itself, like a balanced fund. But typical balanced portfolios are 60-40 stock bonds, 50-50 stock bonds, and they stay very close to that throughout their life. They don't
no matter
change.
how old you are.
Where if this was 2000 and I chose a 20-40 fund, it would be pretty much, it's 40 years till the date, and it would be pretty much all stocks. And now that it's 2023, that same 20-40 fund with me investing in it all this time and doing nothing different, I didn't have to think about it. It should now be with something with a shorter time frame, even though it's still 17 years. It would be less
stock,
than 100%.
more.
And then maybe we go through another 10 years and we go from, now we're at 2033, that 20-40 fund should be very close to being, ready to, within 7 years of starting to distribute income from it. And you'll see that. So as you get closer to that date, the risk return profile comes down
by lowering your
lowering the
your exposure
allotment
to
stocks.
Okay.
The problem is if I'm saying, this is one of the problems that people have with 401ks in general. If I'm saving for a goal, I'm putting a 401k specifically. And target date funds are primarily 401k. They're available outside of it, but primarily they're offered in 401ks. So I'm saving every month, every week, however often I get paid. I'm putting a constant dollar amount or constant percentage of my pay into the 401k on a very systematic basis, otherwise known as dollar cost averaging.
Well, every paycheck you put a certain amount in, the same percentage.
If I'm dollar cost averaging, I want to use what the market gives me to my advantage. And what does the market give me that I can use to my advantage? Volatility. And I want that volatility. So when the market's down, I buy a lot of shares. When the market's high, I don't buy as many shares. If I'm using a target date and 20%, 30%, 40% of it is in less volatile areas, I'm using 20, 30, 40% of my contribution not to its maximum efficiency.
So in other words, you're dollar cost averaging into something that has very little,
that's becoming more bland
volatility
as I go along. Or at least the idea is it's becoming more bland as it goes along. So I don't want to use it for my ongoing savings. So now I have to think. Now I'm doing something that the target date fund said I don't have to do. I have to say, well, my new contributions are going to go into the 2300 fund.
Well, they're going to go into the stock side. You can't do that.
I'm going to use the target date, I'm going to use the longest target date for my future contributions, but I can use the target date of my choice for my existing allocation. But now I'm thinking again. Now this is taking a whole idea of what target dates or funds are all about. But the biggest problem with target date funds is you actually have absolutely no idea of what your allocation is unless you decide to go in and look at it. And frankly, not that many people do. And the other thing is that let's say it's 2023 and we're looking at a 2030 target date fund, 7-year time horizon.
Mm-hmm.
Well, you would think that the one issued by all the different vendors that offer target dates, you'd think they'd be somewhat similar, but they're not. They could be very different in their allocation.
So somebody at one investment brokerage house or whatever has a 2040 target date fund that could have a completely different look to the one across the street that also has a 2040 fund.
The date doesn't tell you unless you look and do some research. Again, taking away what the target date said you didn't have to do. You don't, unless you look at it, you don't know, is that a 70-30 stock bond mix? Is it a 60-40 stock bond mix? 50-50? I mean, at 2030 fund, it's only 7 years away. I would think it'd be more like a 50-50. And I was actually looking at one yesterday with a client, and it was like 73-27. 73% stocks, 23% bonds. And it's only a 7-year time horizon. And then
wait, 7 years till retirement, and there's 73% stock.
That's what that particular one was.
All right.
But then we were talking about target dates, and I said, if we're going to use a target date, he was using his 401k, he was bucketizing himself in his 401k, our only options other than a stable value fund on the one side and stock mutual funds on the other side were these target dates.
Mm-hmm.
So I didn't have any balanced options. I didn't have anything in the middle. So we had to use the target dates. And so we figured, well, 7 years is a good time. But that was a little more aggressive than we wanted to be. So in looking at them, the 2025 fund was still 65-35. It was, so that's a little bit better, but that's a fund that has a 2-year potential target date is still 2/3 stocks. And then he asked me the question, he goes, well, on this list of available options, I see they have a 2020 fund still here.
Wait, 2020?
Hasn't 2020 already passed? And I said, well, yeah, but that's for somebody who's basically, I guess, retired already. Let's take a look at that fund. And we looked at the fund. It was 45% stocks, 55% bonds. 45% stocks, 55% bonds for somebody who is retired and expecting that fund to create a distribution, a stable distribution. Didn't work very well in 2022.
Doesn't that sound like me taking money, selling stocks when they're down?
Yep.
And using long-term assets for short-term needs?
Which, to me, just solidified why I don't like target date funds.
Well, that slams the door for me.
But he only has so many options. So we were looking and we were going into the funds and finding one that fit, not just based on the target date, but based on what his needs actually are, which, again, takes away the whole premise of why target date funds were introduced in the first place.
Well, and they're supposed to take the guesswork out, and they're supposed to lessen the risk as you get closer.
Well, and they do,
right?
To some degree.
Well, no.
But there's no uniformity between them.
Well, but do they? This here says, Morningstar says back in 2008, funds with a 2000. This is in 2008. Funds with a 2000 to 2010 target date.
So a target date that had either passed or was within 2 years.
They lost an average of 22%.
Uh-huh.
Well, that doesn't sound like you're mitigating risk.
Well, the stock market went down 38%.
Well, yeah.
So you were less risky than the market as a whole. But that's, that goes back to, unfortunately, not understanding a strategic plan of how am I going to start taking a distribution from this portfolio. If I'm going to start taking a distribution from the portfolio, I don't want the portfolio I'm taking a distribution from to have gone down 22% last year, because now I'm having to take and sell some assets to create that which will never recover. This is where a bucket strategy really comes in play. This is why and the fact that I believe very much in the bucket strategy compared to a systematic withdrawal from a balanced portfolio is one of my underlying problems with the target date. It doesn't mean you can't use a target date fund, but it does, to me, mean you can't use it without doing some research, which was, again, against the whole premise of why they created these in the first place.
Yeah, and you and I are on the same page about this. If I have a target date fund in my 401k, but I've got other investments too, stocks and bonds outside of that, doesn't that kind of throw that off kilter a little bit too? The whole idea of a target date? Don't my other investments kind of mess with that ratio?
The concept is use the target date exclusively for your goal. If you're going to use the other options, use the other options, and you don't need the target date. But you can use the target date if you're understanding what you're doing and how you're using it. Just like any other mutual fund, if you understand what it's there for, understand the risk relationship between that and other assets, understand what you expect from a correlation, what you expect from a high and a low, up and downside, you can use target dates. But just don't use them for the whole purpose of, I'm using one portfolio to satisfy all my needs, and I don't ever have to think about it. And like I said before, saving into it doesn't work as you get closer to the target date. And when you get to the target date, pulling money out of it systematically isn't going to work. But that doesn't mean I can't use them if I have to. The gentleman I was talking to the other day, he did not have any midterm type investments. We had to use target dates for that, so we had to find one that fit his goals. He did have short-term money available to him. He had direct mutual fund investments, for longer-term investing, where they were specific small, mid cap, large cap, domestic, international, value, growth. He could put together a nice stock mutual fund portfolio for his long-term. It was that middle section. They didn't offer any balanced funds. They didn't offer anything that was more consistent.
But you weren't using. He wasn't using the target date the way it was designed to be used. It was to cover another purpose.
And I don't think you should use a target date.
It was like
and even like the really long ones. I was talking to somebody in their 20s, and they were looking at the fund options, and they had a lot of target date options, and one of them was like a 2060 fund.
Yeah.
I mean, what's that? 37 years, give or take? Yeah.
Don't ask me. Okay, 37 sounds good.
To me, that means it should be 100% stocks.
Well, you got all that time.
Why would I want anything in bonds? And yet that had 4 or 5% in bonds.
Why?
Because it's a balanced target date fund. It has to, and so for somebody who's just starting off, and they don't want to do any analysis on any of the mutual funds or anything. Yeah, they can get away with just using the very longest one, but I'd rather you didn't. For somebody who is getting ready to retire, and you want to use just one fund, this is not going to work.
One target date fund, you're saying?
If you're just going to use one fund of anything, it's not going to work.
No.
And the targets are no different in that.
Yeah.
If you want to do some little research, it doesn't take a lot. Understand what the risk is. Understand what the balance is between the stocks and bonds. You can use them appropriately, but don't use them for your ongoing funding. Use the longest one, or typical stock mutual funds for your ongoing funding. You can use a target date for some of the existing money that's in there. But again, that's being done with some analysis, some thought, some reason for buying it, an understanding of what you're buying in the first place.
And again, not using it really for the reasons that they were designed to be used. I mean, it goes back to me taking eventually my Laserdisc player from 25 years ago, and then I just used it as a doorstop. I mean, it actually worked very well.
As a doorstop?
Keeping the door open in the box. Yeah, it was great. I mean, I wasn't using it for anything else.
Yeah, but the Laserdisc, I think, is a little different in that it had the best picture quality of the types of the deliverables that we had back then for movies.
Yeah, but it didn't matter.
But nobody bought into it.
15 years later,
hardly anybody used it.
No, of course not. No. So
I don't like the premise of the target date to begin with.
Right.
I like the idea of the Laserdisc.
Okay, well, that's true. I suppose it was all right for a few years.
But the whole idea, you're investing. You should take some ownership in what you're doing. I hate to tell you this.
Understand what you're doing?
Yes. Yeah. Know why you're investing it. Understand what's happening. Don't just turn it over to somebody, to a disinterested person that may be 1,000 miles away, who has never talked to you, has no understanding what your goals are, no understanding what your risk tolerance is, and goes by something that they're thinking of, and their idea of what a balanced portfolio with 7 years remaining is different than somebody else's, and it may be different than what you need. Just take a little bit of time and understand what you're doing. And that's the problem I have with target dates. And so the whole premise was, we're going to do this because people are too stupid to do it themselves. No, it's not that they're too stupid. They just need to be educated a little bit and understand a little bit. Doesn't take much. Use what's available to your advantage, and
know
don't
why
rely
you're doing
on somebody saying, "Oh, just put your money here and don't worry about it."
The set it and forget it. The Ron Popeil type thing, right?
Yeah, I mean, that doesn't work for finance. I'm sorry.
I don't think it. I mean, it made him a bunch of money when he was
selling.
Great.
It was selling for creating Bassomatic. That was Saturday Night Live.
Yeah, but blenders, it works for that. It can work for little grills. Things. Maybe until they break. All right. So obviously you're not a big fan of target date funds for many reasons. We haven't really talked about this, but there are also fees. I was reading that the average target date fund had an expense ratio of 52 basis points in 2020. Now, can you just explain what that means for people? Because if you don't, if it's going to cut into your return.
Well, and every mutual fund has an expense ratio. And the expense ratio is what is used from the assets in the fund to pay for the fund management, to pay for their marketing, to pay for their overhead, to pay for everything. And so this can be somewhat misleading, though, if it is truly a fund of funds.
It can have hidden fees in there.
Well, that's just one layer. Mm-hmm. So that's the layer for determining the allocation between the different funds that they're using. But usually it does not include the expense ratio for the funds
investments.
That are the actual investments.
The investments hold fees,
right.
Yeah.
And so you have to just understand. Now, anything that has fees. Now, like an S&P 500 ETF, even they have an expense ratio. It's very small, but that's because they're not actually doing any management. They're just following what the guidelines of the S&P are telling them to buy. And then the expense ratio is what it costs to actually buy and hold and then, do the reporting and things of that nature for the fund. Whereas an actively managed fund has a higher expense ratio because you're paying a team of people to look and choose how to manage the money. So that expense ratios are always something to look at. But with a fund of funds, if you're looking at the expense ratio, understand whether that is the expense ratio including the underlying funds or just the expense ratio of the target date or the top fund that is managing the allocation.
Look underneath and see if there's a fee underneath.
Check under the hood a little bit.
When a target date fund reaches its date, I'm guessing at that point that it does not change its investment allocation going forward, or does it?
Typically, once you get to the date and past the date, like we were talking about in 2020, they tend to stay the same allocation because they're already at the date. They figure that's the best allocation for that date. But what happens, like the gentleman we were talking about asked me, he goes, well, why isn't there a 2015 or a 2010 fund? So when they get that far back, they usually roll it into the next one.
Meaning what? Roll it into the next.
So the 2015 was rolled into the 2020.
Oh, okay.
And then, 3, 4, 5 years from now, the 2020 will be rolled into the 2025.
Oh,
right. After they've met their date.
Yeah.
At some point, it's the same fund. I mean, it's just going to become the same allocation. So they just roll it into the same funds.
So when you're past that and you're past that target date, you are essentially just carving money and then rebalancing. You're doing a systematic withdrawal.
Yes.
Which we've talked many times about and that we do not like.
Yeah. And that's why, while I'm not going to give any recommendations of whether you should keep the money in a 401k after you retire or roll it to an IRA, this is one reason why you might want to roll money to the IRA because you have more control over it. Don't just leave it in a target date and take a systematic withdrawal.
Okay.
But that's what the 401k may offer. And so if you don't like what the 401k offers, your only other option there is to roll it to an IRA and take better control of it.
Okay, so very quickly, before we wrap this up, if somebody looks at their 401k, you just said, and it's true, I've seen it, here are your investment options for your 401k. And on page 23, you'll see the next set. It's overwhelming. So,
I mean, we look at our 401k, I think we've got 300 or 400, maybe more choices in there. It's daunting.
It is a lot. So what is the average person supposed to do if they say, well, I could just do a target date fund. I know you don't like them, but I don't want to go through all this. So what should a person do when trying to consider what they should do within their 401k with all those choices?
First thing is figure out what you're trying to accomplish. Is this a brand new 401k?
You mean are you young or brand new?
Brand new to you, or are you young, brand new to the world of investing?
Okay.
I mean, you may be 55. You're not young necessarily,
right,
but you've got a new job,
and
you're starting a brand new 401k.
All right, so that's what
I would not use a target date for that. I would first off try to go through my options, ignore bonds, ignore target dates, ignore safety, ignore all that, and just look at my stock funds. Okay, that just whittled it down to quite a bit. And look for ones that I may have heard of or may know, or then evaluate just that subset of the entire offering and pick what you think is best, or have somebody help you do it. So it's a matter of understanding what you're trying to do. Now, maybe it is the same. I've been with this company for 30 years. I've got X amount of dollars there, and I'm getting closer to retirement. Maybe I'm 60 and I want to get closer to retirement, and I'm going to try to bucketize my 401k. Now, I'm excluding the fact that I may have other assets that make better buckets, but
all right.
It depends on what the person doing. Okay, I'm going to take a look at my choices, but I'm going to go back to that same thing. I need to have some money in bucket number one. What of if I'm doing this, and if that's what my plan calls for, which of these options, and there's only going to be a couple of them that are appropriate for bucket number one. Okay,
there's only going to be a couple in the 401k,
right?
Yeah.
Because if it says stock, not appropriate for bucket number one. And then you look at the bonds, long-term bonds, mid-term bonds. You're basically whittling away everything that's not appropriate. Target date funds, in my opinion, are not appropriate for bucket number one. It's going to be a stable value fund, short duration funds, and things that
if they even have them.
Yeah. So let's see what they have available, and then do the same thing. But that's for my current allocation of existing. I safen up the existing money. I use the dollar cost averaging for my future contributions to be aggressive.
The money you won't need for 15 years.
Right.
Yeah.
Because the idea is that I got $1 million in my 401k. I'm moving some of it to bucket 1 and 2 so that if the market goes down, market goes down 25, 30%. I don't want my portfolio to go down by $250,000 to $300,000. But the $1,000 I just put in last month, it went down 30%. Okay, I lost $300 on that investment. That one doesn't hurt me, but I want that volatility so my next $1,000 that goes in buys that much many more shares.
Mm-hmm.
So there's going to be a difference between my existing allocation and my future contribution allocation. But again, this takes a little bit of work.
It takes work, and the average person may just throw up their hands. And what you're saying
and that's
is,
why people weren't doing it, and that's why people they pushed and came out with these target date funds.
Yeah, which, in your opinion, are just...
Well, it's like anything else that's set and done for me without asking me anything about me. I mean, it could work, and it's better than nothing. If your choice is to not do it or use a target date, use the target date.
Okay, good. That's where we were leading.
It's better than not doing it. Saving, even in the wrong investment, is going to be better than not saving it.
Yeah, well, and by the wrong investment, you mean, but you still got to have the time.
Yeah.
I mean, don't dump it into the snake oil.
Yeah, I mean, if you're saving for the future long-term growth and you accidentally use a short-duration fund, I'd still rather you save the money, even though it's not going to make as much money, because the discipline of saving is the hardest part of investing reality.
Well, there's
because you could be the best stock picker in the world, but if you don't have any money, if you've never built up any money to buy that stock, it's not going to do you any good.
That's it. Build the discipline to do so. Well, this has been a fascinating discussion. I'm really surprised we haven't talked about target date funds before. You're not saying they're worthless, but you're saying, again, know what you're buying and
very much so, yes.
Use them strategically. You don't like them for the
purpose they were built?
Purposes they were designed. Well, yeah, right?
I'm not a big fan of that, but that doesn't mean they can't be used.
Yeah, okay. Under the right circumstances.
Especially if they're the only option you have.
Save anyway is what you're saying. If you want to know
save
more,
early, save often.
That's right. You want to know more about this kind of thing, and maybe you've got a 401k. Maybe you're just starting a 401k, and you need somebody to take a look at it for you. You want a financial advisor can really help you in this regard. So you need to have a financial advisor as part of your, team of people who look at stuff like this. Go to Lucia Capital Group. Talk to them, 800-644-1150. Professor Plum, you do this kind of thing, I know, all the time. Somebody's got a new 401k, as you just said. They just started. Now they're 45 or 50, and they've got less time, so what should their 401k allocation be?
Or even if it may not be that they have less time, and maybe they already have a lot of money in other accounts, but this is a new option for them because they switched employers. And how do we utilize that most efficiently for their overall situation?
800-644-1150, the number at Lucia Capital Group. Don't forget to subscribe to this podcast. Boy, have you missed a lot of stuff over the last 10, 12 weeks. We've really been hitting home runs, in my opinion. We're darn good at this, I got to say. Go to Spotify and iTunes. You can download this podcast and subscribe. Get it every single week. And I think you'll be glad you did. Also, go to our website, luciacap.com, LUCIACAP.com. We've got years of material up there, and you can take a look. Professor Plum, thank you so much.
Welcome.
As always, I appreciate you being here for Professor Rick Plum. I'm your podcast host, Johnny Dean. Thanks so much for listening, managing your financial future. We'll talk to you again next week.
Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high yield, small cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Stable value funds can be viewed as an alternative to money market funds. However, there are important important differences, and stable value products can be complicated. Unlike money market funds, stable value funds are typically not registered with the SEC. In addition, they are not guaranteed by the U.S. government. The structure of or investments within stable value may vary, and it is important to consider these differences in selecting a stable value fund. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider a target date, stable value, or an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. A dollar-cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.